Business since 1999, right?
Well, in this company, yeah.
1999 in this company. And you have a previous for how long?
1982.
1982. So we have a lot of experience regarding a 1031 exchange. May I introduce Phil Edward.
All right, Phil.
Good afternoon, everybody. Thank you for being here. How many of you have actually sat under one of my seminars or training before? I know a bunch of you have. Even my neighbor here has. We live very close to each other. It's a pleasure and honor to be here today. I want to talk about investors. You can feel free to ask me questions at any point. It's not a problem. Because I want you to get out of this what you think you're going to need. We want to remember that we're dealing with real estate investors when we talk about 1031 exchanges. What's so unique about real estate investors? Well, I'm going to tell you the 4 things that you have to know about them. Why do you need to know these 4 things about real estate investors? Well, because number 1, they don't care about you. They care about themselves. They all listen to the same radio station all day. I don't know, maybe you listen to KISS FM. Maybe you listen to 710. You listen to sports. Maybe, I don't know, maybe News 1070. But let me tell you the station they listen to all day. WIFM. You ever listen to that FM station? WIFM. What's in it for me? That's all they care about. Okay, what's in it for them? Do you ever wake up in the middle of the night thinking about something, maybe worried about something? They do too. And they even pray at night. But you know what they don't pray? They never say, "Dear God, please send me another real estate agent." God, please. That is not what they're asking for. What is the 4 things that they want? Well, you actually touched on it. It's actually money. It's very important. But let's break that down. What does that mean? Number 1, cash flow. Investors buy properties so the properties will work for them so they don't have to. Now think about it. How would each one of you like to own 2, 3, 4 properties cash flowing, positive cash flowing every month? Yeah, okay, I was getting worried about you. You didn't say anything. Yeah, absolutely. Sure you would. We all would. And that's what investors are looking for, cash flowing properties. Number 2, why? Because they want the properties to work for them so they don't have to. How many would you like to have your properties work for you so you don't have to come in every day? Right? Number 2, they want a tax break. They want a tax write-off. And investment real estate produces something called depreciation. Depreciation is a wonderful thing. It's embraced by tax investors or real estate investors. How many of you think taxes are going to go down? Don't think so. I think they're going up. With the new health care program, it's going up. They've already announced next year, not only the 3.5% for a transaction, but capital gains taxes are going up as well. And they're looking for a write-off to keep their money. Number 3, not only do they want to cash flow the property, not only do they want to write the property off, but number 3, they want to be able to watch the property grow in value over time. Now think about that. What can you buy that you don't have to come in all cash? You can leverage it with the lender, right? Number 2, you can write it off. 3, you can take cash flow from it. And then number 4, you can watch the value go up. I mean, what other investment is like real estate out there? I can't find another one. Can you? There isn't anything quite as unique like that you can watch it go up while you take the cash flow and write it up. And then number 4, the last thing that they want is safety. They want security. They don't want to lose that asset. And we call that in our business diversification. They can actually take the equity and not keep it all in one basket or one property. They can diversify. And that's why investors, since December, and we've noticed an increase, because you know we've kind of been in a challenging economy, haven't we, in the last 5 years? And we're watching investors beginning to list and exchange more and more again. Why? Because those are the 4 things that are driving them. That's what they think about. When they eat dinner, that's what they think about. When they go to the bathroom, that's what they think about. When they go to sleep at night, that's what they think about. Those are the things that motivate them. So the question is, how does the 1031 exchange help them achieve that? And then the second question today is, how do you, once you get it, how do you create new relationship? How do you find investors? Number one. And number two, how do you create relationships with investors? Because it's very important to be able to grow a relationship with different investors. Because honestly, you get about 5 or 6 investors working with you, you may never have to prospect again. Because those people buy not because they have to, but because they want to. Because they see opportunity knocking in a property where they could buy and make more money. Exactly, those 4 items we talked about. You know what the difference is between somebody who who's selling their primary residence versus somebody who's selling their rental property? Well, there's 2 things. Number one, they have something in common. They're emotionally attached. But the thing is that they're emotionally attached to different things. The one who's selling their primary residence many times is emotionally attached to the house. The investor is emotionally attached to their money. They didn't buy it to live in it. They bought it to make money. And that's why they're more prone to want to sell it if they can make more in those 4 areas that we talked about. Are we together so far? Does that make sense? That's what drives these people. That's what drives us to be in this business and to be able to work with people like that. And that's why I say, you work with good, half-dozen good investors, you may never have to prospect again because those people are constantly on the move. So let's talk about that. Not only how do you work the exchange, but how do you find them and make relationships. We'll save the relationship part to the end, okay? Let's talk about how the exchange works. Let's take an example. Let's take Sam. Sam buys a property 15, 20 years ago, maybe 25 years ago. He bought it for $400,000. That's his purchase price, all right? Well, 15, 20, 25 years go by. The property isn't worth $400,000 anymore, is it? It's worth over $1 million. He sells it for $1 million, all right? How much does Sam realize when he closes the sale? That's $600,000. Now, that's a very, very rough estimate because you have issues like depreciation, capital improvements, all kinds of things that have to enter into this, but we're not going into all that today. We're just going to keep it very simple. He wants to live with $600,000. At the close of escrow, when he sells it, he's very happy. But then standing in line at escrow are a couple of people. Number one is the IRS. And the IRS says, congratulations. The government says, well done. Barack Obama says, great. I want my money now. What does the IRS, how do you spell the IRS? Anybody know? I'll show you. Don't forget, it's at the end of the test here today. How do you spell the IRS? The IRS. What does that spell? Theirs. Oh, the government's trying to talk to us, huh? What do they want? Well, today, they want their part of this. They want 15% of this. So 15% of $600,000 is roughly $90,000. That's the first thing you want. But don't get too happy with yourself because that's going up next year. The new health care program that they just, did and all that, that's making this go up to about 18.5%. Then they want to tax more the people who make $200,000 because they're rich.
Wow.
Boy, $200,000, does that make you rich? I don't know about that. Not in California. Maybe in Kansas it does. But not necessarily here. But they want to change that. And we're looking that this is going to be somewhere between 18.5% to about 25%.
Wow.
But today, to the end of the year, it's 15%. And that goes to them because they think it's theirs. Number two, the government says, well, we'd like to tax you on something else. One of the benefits we just said a minute ago of doing of owning investment real estate is you get to what? Write it off, right? So you get to depreciate. Now you don't depreciate the land, you just depreciate the building or the improvements. And you get to take that depreciation over time. If it's a commercial building, you get like this, it would be depreciated over 39 years. But if it's a residential building, it gets depreciated by 27 and a half. Very close, very good. So you get to take this depreciation each year, this write-off, and they love that. The problem is the IRS says, guess what? We want to tax you on the write-off we gave you. That's like somebody coming to your birthday party, giving you a gift, and then want to know where the tax money is on. Yeah, it's crazy, but that's what they do. So that tax on the depreciation is 25%. Not up to 600, but the amount of depreciation. In this case, it was $400,000. Let's say you depreciated 200 of the $400,000. That means 25% of the $200,000, which would be $50,000. On top of is $90,000. Next, we can't leave out the state of, we used to call it California, but Mr. Schwarzenegger isn't here anymore. He's making new movies. So now we have Uncle Jerry. And Uncle Jerry says you can pay us a tax when you close this escrow. Ultimately, he's going to take 3 1/3% of the sales price, but really that isn't the tax. That's just a withholding. The real tax is 9.55.
How much was it again?
9.55, almost 10% of that. Another $60,000 for California.
That's for California?
Yeah.
So how do you get the 25% for?
For the depreciation recapture off the, it applies to the portion that you were supposed to depreciate while you had it. So we're assuming since he's had it for 15 or 20 years, that he took about, let's say, 200,000. We're just sticking around. So that's, then you pay the 25% tax on that. Make sense? Okay. Guess what? One more thing the IRS says, that if you don't take the depreciation you're supposed to, you know, that they allot to you, guess what they do when you sell the property? They still tax you on it even though you didn't take it. So you better take it. Because it's not good. They're going to take it back. And this is what you, oh, by the way, the governor said that this is going up.
Ooh.
They're talking about a tax increase for our state. They're talking about 11.5%. So we might go another 2 points up. Doesn't matter. That's just going to be your income tax. And this would fit under your income tax. This would be considered a long-term capital gains tax on the federal end, because the federal has a distinction between what you make in a year or less versus a year and a day or longer. A year and a day or longer is called long-term capital gain. A year or less is called short-term or ordinary income tax. California in this charges only ordinary income tax. And that's the one that's probably going to go up from 9.5%, maybe about 11.5%. Okay? But that's what you pay. Now this is what the seller says at the close of escrow. We had Jerry standing there. We have Barack standing there. So they say at the end of the close of the escrow officer standing there, and this is what the seller said. He goes, "I just don't remember taking title with you boys and girls on title with me on the property. So why is it that I got to give you such a big chunk of my profit?" The answer is, welcome to the United States of America. In 1921, the Congress said, we're going to give a break to the investors. We're not going to give them free tax. But we're going to let them defer the tax. We're going to let them take all this tax money they would spend. So this would be 90, 110, and then the 110, 125. Let's call it just a flat $130,000. All right? And they're going to say you can keep that money if you reinvest it into like-kind property. So let's say Sam, who sells this $1 million property here in San Marino, has a 3-unit building. And Sam's decided it's okay, but I'm a little tired of tenants. I don't like those phone calls. I don't like those complaints. I'd like to buy vacant commercial land in Colorado. He sells the property in San Marino. and he wants to do a exchange into vacant land in Colorado, but it has to be like kind, and that land is commercial land. Is that like kind? The answer, who says no? Who says yes? Who's not sure? Who doesn't care? The answer is yes. Because like kind has got to compose of two things. Number one, real property. Number two, real property that's held for investment or productive use in your trade or business. Can I exchange units for vacant land and hope that the vacant land will appreciate in value? That would be investment real estate, would it not? What is not considered investment real estate? Primary residence, second home, vacation home. Like my Uncle Rocco in New York says, forget about it. Doesn't count. It has to be investment real estate. It's got to have those two composites. And a second home or vacation home does not qualify for that. It never will. Pardon me? Absolutely. Single family will always qualify if I don't live in it, right? It has to be investment. So, I can exchange anywhere in the country. Can I exchange out of the country? The answer is no. In some rare situations, the IRS will let me exchange, very rare. It's like a U.S. territory like Guam, Puerto Rico, U.S. Virgin Islands, Iraq, Afghanistan, any U.S. territory. I want to see if anybody got that. Is everybody paying attention?
I said it like it became part of the United States.
All right. So anyway, so the bottom line is the IRS will allow me to exchange anywhere in the country, and that's the beauty. And like kind means any investment real estate. Remember we said that the number 3 security people don't want to put, or number 4, they don't want to put all their eggs in one basket? Isn't that the beauty? I can sell property here and go to other places, other states, and other types of properties. Like I hear you can get a really good deal in Louisiana right now. Right? You know what I'm talking about? What am I talking about? New Orleans, right?
Beachfront property?
Yeah, beachfront
There
property,
you go.
exactly. You can take advantage of opportunities everywhere. As long as it's investment real estate. So that's the beauty of it. So here's the question. How does the 1031 exchange work? And how do you deal with it? How do you know how to deal with it should some of your investors decide to want to move their investment property around? So let's say you're taking a listing. I brought some of these today. I don't know if I have enough. Hopefully they will. Thank you. The question is, what do you do when you take a listing? The answer is, you ask questions. And here's one of the questions I would recommend that you ask. Ask your seller, why are you selling the property? And what do you plan on doing with the proceeds from the sale? Now, why would I ask that question? Well, because I found out that it is a rental property. It's investment real estate, right? So my question is, number one, why would I ask that question? Is because if they're planning on selling and then maybe buying something bigger and better, and when an investor sells a condo, many times they want to buy a single family, or if they're selling a duplex, they might want to buy a 3 or 4 unit building, right? They want to grow. That's what investors do. They want to grow their portfolio. So that's why I want to ask that question, because I just don't want to take the listing. I also want to help them buy the replacement property. So I want to work on 2 deals, not just 1, right? Make sense?
Yes.
The other reason is because they may have a tax liability. Now, as real estate agents, you know, you and I, we're not supposed to be giving tax advice, right?
Right.
But we can give them legal advice. That's okay, right?
No.
Wrong. Okay, everybody is aware. So the bottom line is that we can't give them tax advice, we can't give them legal advice, but we can say something like, you may have a capital gain that you might have to pay taxes on. You might want to ask your CPA if you should maybe do something called a 1031 exchange. And in 1921, Congress, like I just said, is going to allow you to reinvest into a like-kind property and take all these taxes, including your estate taxes, and put it into the purchase of the new property. It's the best stimulus package that was ever invented. Why? Because it lets you keep your money and reinvest it so you can make more money. Number two, when you go to work and you close a deal, people get paid. You get paid, escrow get paid, title gets paid, the county assessor or the county gets a transfer tax. People have to paint or build or repair. It just puts it just puts a lot of people to work, which means a lot of people stimulate the economy. It's the best thing that you can do. So that's why they did that. So they said you're going to take this and reinvest it anywhere in the country. And that's the beauty of the exchange. So those are the two questions I would ask. Why are you selling, if you know it's a rental property? And what do you plan on doing with the proceeds? Because you want to be involved in it. Okay, now the question is, if you've got a listing, do we have enough of these to cover?
Yeah.
Okay, good. Now that you have a listing, the question is, what makes a sale a 1031 exchange? How does this seller get the benefit of this deferring of all this tax? Is it automatic? The answer is no. What is it they have to do? Well, you have to put language in your sales contract to make this a 1031 exchange. And what language do you put in? If you open up the first page, you look under where the little box where it says C, it says what language should I put into the sales contract? It's basically the same language that's in your zip form. Everybody familiar with zip form?
Right.
Yeah. Just take it out of there. It's just the intent to exchange piece. That's all it is. You get it in there and boom. It just as long as the buyer accepts it, everything's good. A lot of people put it in the MLS. It says seller is going to be doing an exchange and the buyer is going to cooperate. You've seen that before, right?
Yes.
But the bottom line is, it's nice to have it in the listing, but that isn't where it counts. The government said it has to be in the sales contract. Very good. Now, what if the seller is not interested in doing a 1031 exchange? Gets a 60-day escrow. Day 58, they're having lunch with their CPA, and they pick up the check because they're making some money from the sale of this property. The CPA says, "Well, are you going to do an exchange?" And the seller says, "Nah, I'm not going to do an exchange. I'm just going to sell the property and keep all the money." So the CPA goes to explain how $150,000 of this is going to the government. All of a sudden, they can't breathe. They have to call the paramedic. They're laying on the ground, and he says to the CPA, "How do I do a 1031 exchange?" And here's the answer. Should have put it in the contract. Things going to close in another day and a half. Is it too late? The answer is no, because escrow hasn't closed. What can you do into a contract that hasn't closed?
Amend.
Very good. It can be amended. At this point, escrow will do the amendment. So you'll call me, I'll call escrow. We'll get a copy of the contract, and we'll get a copy of the preliminary title report. You have escrow here, don't you?
Yes.
Okay. Where is your escrow?
Right back here.
Right here. I have to go say hello. And then I'll talk to the escrow officer. We'll get those two items, and then we'll email out the new exchange documents that the seller and the buyer sign. Why does the buyer have to be a part of this? Is there any tax liability to the buyer?
No.
Is there any cost to the buyer?
No.
So why does the buyer have to?
Disclosure.
What are they participating with? Not a witness. I'll tell you why. Me. You need a third party to facilitate this exchange on behalf of the seller. And to do that, we have to be a part of the escrow. And for us to be a part of the escrow, guess who has to allow us in? The buyer. That's the bottom line. That's the bottom line. It's very simple to get done. Like we said, all we need is just that information, escrow will draw the amendment, life's good. But we have to get it done before escrow closes. I get calls after escrow closes sometime, and they say, "I need to set up an exchange, escrow's still holding the money, escrow closed yesterday." The answer is, let me ask you, let's say I break open an egg, I'm gonna make scrambled eggs, right? Yeah, I changed my mind. I really wanted sunny side up. So I stopped whipping and I put it backwards. Can I unscramble the egg? Of
No.
course not. Well, that's what happens when you close a sale. It's done. You can't unscramble it anymore. So the bottom line, the IRS won't let you do it. It's got to be set up before escrow closes. Now, that escrow closes, there are different ways of achieving this exchange, and I want to give you a handout for that one. If I can get them out. There we go. Who's going to help me out with this? Yeah, thank you. One's white, the other one's yellow. They're identical. It's called the 6 types of 1031 exchanges. Today I'm going to concentrate on 3 of them because it's really only 3 ways to do this. The other ones are kind of modifications of it. But this is what you really, considering how much time we have today, this will really fit the bill. Number 1, I can close my sale and my purchase concurrently or simultaneously. All right? When I was driving up here from my last appointment, somebody called me up from Pasadena and said, I have a couple of people who need to do 1031 exchanges, and they just want to trade with each other. They have one property, the other guy got a property, they just want to trade properties with each other. Can they do that? The answer is yes. Can I sell to one party and buy from another party and close these 2 escrows concurrently? The answer is yes. You can do a 1031 exchange that way. Number 2, delayed. Delayed says I can't close a purchase the same day I close my sale. The IRS doesn't care when you open escrow, they only care when you close. So I can't close my sale and my purchase on the same day. So the government says, okay, because they lost a lawsuit, which is really nice, you can now, as an investor, close after, you can close a purchase after you close the sale. How much longer past it? The answer is 180 days. It's not 6 months. It looks like 6 months, but it's not. So this is how it works. Today's the 29th. Is this 29th already? Do you realize that, what is this? 4 months from today, it's almost New Year's. Christmas is finished.
Wow.
I mean, it's unbelievable. What's happening? So today's the 29th, right? So today I close my sale escrow. Starting tomorrow, which is the 30th, is day 1 of 180 days. Now, 180 days can go into next year. It's okay. But I have to close my purchase in my exchange before the end of the 180 days. That's it. It's got to close before. If the 180th day lands on a weekend, when the county recorder is closed, or a holiday, do I get to the next business day to close my purchase? The answer is no.
Oh, no.
They don't care whose birthday it is. Martin Luther King, George Washington, Jesus Christ. They don't care. That's the 180th day, and there's no next business day. Weekend, the county recorder is closed, couldn't care less. That's the day, no extension. So you have to close before that almost 6 months, which is really 180 days. And it begins the day after your sale closes. That's day 1. Okay? Make sense? Okay. Secondly, the IRS got very angry when they had to do this delayed exchange because they did not want to do that. So now they have to. So this is what they did. They said, okay, we're going to give you the first 45 days of this 180 days to name the address of the property you're going to buy. Or properties, because you may want to buy more than one. Because there's no reason why you can't exchange them to more than one. Right? Diversification. Multiple properties. Or some people want to sell one property to go into, want to sell multiple properties to go into one property. People want to do that as well. One property of great value. Either way, the bottom line is you still have the 180 days to acquire, but the first 45 days to name the address of what you're going to buy. Now, does that mean you have to have a contract within 45 days? The answer is no. Does that mean you have to have an escrow in 45 days? No. They don't care when you open escrow, they only care when you close, just like we said a minute ago. So we have 45 days to name the address of the property, 180 days to close. Now, under the 3-property rule, the IRS will give you how many properties they will let you name under the 3-property rule. Anybody want to guess?
5?
Very good.
Really?
No, 3.
Okay.
That's right. That's what I said. Yeah. 3-property rule says 3, so I can name up to 3 properties. And on this one piece of paper, I can put down 1, 2, 3 addresses or tax parcel numbers or APN. Can I change the addresses on this list? Sure. How many times? Doesn't matter. Anytime I want to, right? Sure. As long as they do it before the end of the... What about on day 46? This property is no good anymore. It's got problems. The seller withdrew the listing. Another buyer bought it. I need a different property on this list. And it's day 46. Can I do that? Whatever's left over on that list, you can keep changing them, but you can't go over 3, and you have to stop the identification. In other words, the identification cannot be altered after day 45, or it's tax fraud. The government puts you in jail to figure it out. So the bottom line is that this is the most critical part of the whole exchange right here. Let's put it this way. Why would you want to sell a property if you don't have something better to go into? If you're just waiting for the 45 days to find that property, guess what? Last time I checked, inventory is not that good. There's not an abundance of properties. Why would I want to put myself in a position to sell and pay capital gains taxes? I'll just keep what I have. If I can't find something better, if I can't find something better, then I'll exchange. Why would I sell if I didn't want to? That makes sense. That's what the key to the exchange is, not selling. The key is finding better property where you want it to be, the kind of property you want. And that's the bottom line. But the IRS does give you 45 days after the sale is closed to figure out what that is. And my recommendation to you is you figure that out before you close your sale. Because once you close your sale, I like to consider this as grace period. That makes sense?
This is regardless of whether you're buying the state or on the state.
Doesn't matter, as long as it's in the U.S. Because you still have 45 days to identify. Any questions about that? Yes?
No.
Next, there's a third kind of exchange if you look at that sheet we just handed out to you. It's called the reverse exchange. Reverse means backwards. When I leave here today and I start my engine, first thing I do is turn on my air conditioner. But when I want to leave, I'm going to put my car in reverse, or R. So I back out of my spot. An exchange, a reverse exchange, means I'm going to do this exchange backwards. I'm not going to sell anything. I'm going to buy first. And then, after I secure my sale, that is close, remember, because it's all based on closing, I'm going to close my sale up to 180 days later. So I'm going to first buy and then sell. Now think about it. Doesn't that make sense? In a market where inventories are kind of on the lower side, where you don't have a lot of selection, and you're not sure, you're afraid. People do reverse exchanges because, number one, they want the right property. They don't want to be forced to go into something that they feel won't be the best deal for them. Secondly, they're afraid of this 45 days that they won't be able to find anything. But here's the big deal about a reverse exchange. Where's the money going to come from to buy? You haven't sold anything. You got to first buy and then sell. So what is the seller going to take from you? Credit? Credit card? You have to come up with the funds. You have to have a bridge loan or a swing loan. We have financing available that we can refer you to. It's temporary financing, it's transition financing. Maybe we can help you acquire that property. But the bottom line is, maybe you have money in the bank. Maybe you have an uncle, rich uncle who you can borrow from. Maybe you can get a line of credit off of one of your properties that you own or your home, so it'll help you get into them. But you have to come up with something to be able to buy. Second thing is, when you go to buy, you can't take title to the property. We have to take title to the property. We have to set up a corporation that's going to take title to the new property you're buying. And we will hold title to that property until you close your sale. So we'll hold that property. You'll get to manage the property, you meaning the owner, collect the rent, take care of the tenants, do all the things that you need to do. We'll work out a triple net lease from you because we don't want to manage the property. That's the owner's responsibility. We're just holding it for the owner because the IRS won't let them have title to both what they're selling and what they're buying all at the same time. So we'll hold it until the sale closes, and the sale has to close within 180 days. Pretty simple. Make sense? Okay, and that's all the reverse exchange is. So it does require financing to get into because you're not selling it. But it's a great exchange. Yes?
But how is that gonna affect them if you're gonna hold title? I mean, the 180 days, is that gonna affect them in any way?
No, because they still sell their property, and the moment they close their sale, we deed the property to them as a replacement. That's the way the IRS set it up.
I have a question.
Yes.
Maybe you're on this, I did you buy multiple properties with the proceeds you still come to one, or is it one or what?
As long as it's considered as like-kind, like we described before, it's investment real estate, and you identify it in 45 days, the answer is yes. You would use either this 3-property rule, or if you're going to buy a lot of properties, like you want to go out to the desert or out in the country,
So
or
you've got $1 million and you can somewhere where you can buy a property, rent a property for $150,000, you think you're not buying 6 or 7.
right, then you would not use the 3-property rule. You would use something called the 200% rule, which allows you to identify based on how much you sold for, not based on the number of properties. You can name up to multiple properties. You just cannot identify more than 2 times whatever the sales price is of what you sold. So if you sold for $1 million, $1 million times 2 is $2 million. You can identify up to $2 million worth of property with no limit to the number. Make sense? So you can do that, absolutely. The key to an exchange is to buy equal or greater than what you sold for. And all the cash from the sale needs to go into the purchase. So if I sell for $1 million, and after I pay off costs and debt, non-recurring closing costs, I have left $600,000. All the $600,000 needs to go into the replacement property or properties that I want to exchange into. But what if, it's time for me to get rid of my Corvette to get a brand new one. I'd like to buy a brand new Corvette. So I tell the escrow officer, I want to hold back $100,000 of the $600,000 that's coming out of the sale. Can I do that and still do a 1031 exchange? The answer is yes. But the $100,000 that I take and I put in my pocket, I pay taxes on. So I can still do something called a partial exchange, where I get to keep some of the money. That makes sense?
And then the 100% that you're gonna, and the 100,000 that you're gonna keep,
You're going to pay the 25% recapture, but only on that amount. Same is true with the 15% capital gains and the 9.55 on the state. But that's it. I can still do it in exchange with the rest of the money. People ask that all the time. Can I still do it? Here's another big question I get all the time. Can I do a 1031 exchange, and how long can I wait before I have to move into the property? Because I just had another person ask me that. I have that. That's the #1 question most people ask. How fast before I can move into the property? The answer is, you can't. Why? Because it's supposed to be investment. Yeah, but I know, I understand, but how long do I have to wait before I can make it non-investment anymore? The answer is the government won't tell you. Why? Because if they did, that's what you do. And they don't want you to do it, so they won't tell you. But they also recognize that life happens. Your money can change, your finances can change, your health can change, your family situation can change. Things can change to affect your life where maybe you have to move into the property, And as long as it's reasonable, the government might buy into it. But you and I can't tell the client that. Who needs to tell the client that? The CPA, the tax advisor, not you or me. Because then you and I are giving what?
Right.
Yeah, I can't do that. It's illegal. We're not licensed to do that. You're not licensed to do that. That make sense? So that's basically how the 1031 exchange works. So based on the amount of time I have left over, which is a few more minutes, I guess, right? 10 minutes? Here's the question. How do I find these people, these investors, and how do I create a relationship with them? You've got to make a relationship with them. Look, I'm telling you, don't be mad at me, all right? People aren't going to buy from you the first time they see you. You have to take the time to develop a relationship. What do you base a relationship on? Trust. It's somebody bringing something of
Value.
value to you. And what's of value to an investor? More cash flow, more write-off, more appreciation, and more diversification, more safety. That's what they consider valuable. So you have to talk to them about what's valuable to them, not to you. That makes sense? They don't care that you close escrow on 2 properties every single week. Doesn't mean anything to them. What it means is like, what's in it for me? Remember we said that, the radio station, WIFM, what's in it for me? That's all they listen to. So you have to talk to them based on that. And that's why I've created some marketing pieces I'm going to give you today. I have some of them, there's more than what I've brought today. If you'd like them, I'll give them to you. See, I'm going to bring something of value to you. I'm going to bring you these marketing pieces so you can go out and make some money. And I'm going to give them to you. All you have to do is send me an email. It's on everything. My email address is on everything I've given you today. And say, Phil, not only are you the best speaker we've ever had, but no, I'm just kidding about that. But say, please send me the marketing pieces. And I'll send them to you, not in PDF, but in Word. Why would I give it to you in Word? Because you can take me off and put you on. You can change the document. Just don't change what we've written. Just change your my name off and your name off. Fair enough?
Yeah.
Okay. Here's the first one. I think we have enough. 7 important questions every investor needs to ask. Thank you. Really quickly, since we only have 10 minutes, maybe 12, who knows? Here's 7 good questions that an investor thinks about. Number 1, how do I make more cash flow? Number 2, how hard is my property working? Is that a good question?
Yes.
They're coming around. Now, is that a good question? If you ever hire anybody to work for you, you say, I'll pay you so many dollars an hour or whatever, you do a job for me. Do you expect them to go work really slowly, or you want them to work hard? Well, how hard is your property working for you, and how do you measure that? That's a good question, isn't it? Not everybody knows the answer to it. We'll go over that today. Number 3, am I using as much depreciation as I can? Because the more I can get of depreciation, the more money I make, even though I have to pay a recapture tax. If it's 25% recapture tax, that means I get to keep 75, right? And I want that because it's good for me. Number 4, how do I reduce stress as a manager? Number 5, how do I reduce my risk by diversifying my portfolio? Many people are not sure. Number 6, how do I protect my estate with title? Not to get a title policy, but the way I take title. In other words, if I were you, I'd make a relationship with a really good estate planning attorney and have them write 2 paragraphs for you twice a year. Mail that information out to your farm. Tell them that you're going to get their name and their phone number and their article as it relates to investors and investment properties in terms of their estate planning and how to protect them, their wealth as when they die and they pass it on to their family or whoever they want to give it to. These people will write articles for you as it relates to their investment properties. And I'll tell you, it's something that an investor will read because it's short and it relates to their properties. It's nice. You know, you know what the tax planner is going to say? The estate planner? They're going to say, this guy's is giving, you're sending customers to me. Well, guess what happens when you send customers to people and you're a real estate agent? People are going to want to do what? Reciprocate. That means you're going to create new business for yourself. And there are clients that get this, are going to look at this and say, they're not sending me junk. Like all the other real estate agents. You know what the other real estate agents say? I'm number one. They couldn't care less. They want to know what's in it for them. Really make sense?
Yeah.
Same is true with number 7. CPA. Get a good CPA. You should have a good CPA who works with you. Just like you have an escrow officer, you have a title person, you have a mortgage person, you have an exchange person. You now need a CPA that you can refer your clients to, because that will create new business for them. Your client will be taken care of. Everybody wins. Okay, very quickly. How do we find these people to give this information to them? Where do you find investors? Where do they hang?
Associations.
That'll work.
Action?
Auctions, yeah, some of them go there, but you don't know which ones are investors and which ones are just trying to buy for themselves. I'll tell you where to find them. Title company. Very simple. Absolutely. You tell your title rep. Who do you work with?
Different ones,
Good.
investors,
Yeah, just
lawyers,
Chicago,
different ones, exactly.
First American, whatever. Okay. If I were you, this is what I do. I would ask for a farm package from the title company of all the investors who've held their properties no less than 15 years. 15 years or longer. 20 years, 25, 30, 15 or more. You want the people who have what?
equity.
Absolutely. You tell them, single family, absolutely. Today I spoke in Whittier. A lady came up to me afterwards. It was at an office meeting like this, but the meeting was in the morning. And we were talking about this, get an absentee owner, out-of-state owner, a single family or 2 to 4. And you know what she said? That's what I've been doing for 20 years. I said, how does it work? She goes, all my business comes from there.
Wow.
She goes, I communicate, I send a newsletter, just like what we're talking about, every month to these people. She goes, I'm the top producer in the office. Nobody's willing to do that. She goes, but I do. That's how I get all my business. 15 years or longer. Single family, absentee, 2 to 4 units, 5 units and above. And if you want to leave that area, you can get gas stations, car washes, office space, retail, small retail, whatever you want to do, whatever you feel the most comfortable with. But 15 years or longer ownership. And this is one of the things you sent to them. Next, I'm going to give you a couple more because we're running out of time here. It's called, has my investment property unleveraged itself? Some of them are white, some of them are pink, but it's all the same thing. Thank you. There's 2 things that you have to know as an agent that's going to be translated through this. There's something called ROI, and there's something called ROE. ROI stands for return on. Now let me ask you a question. If you have a farm package of investors who own those properties for 15, 20, 25, 30 years, whatever, 15 years or more, bless you. Have they had a good return on their investment? Absolutely. They have one regret. And what do you think that is? Who said that? Say that so everybody can hear you. Didn't buy more. Because prices were cheap. How would you like it? It's 2012 right now. How would you like it if I made it 1992 right now? Would you like to go buy some property with me? Why? It's cheap. So they've got a good return on their investment. But here's a question they haven't answered yet. Because they didn't even know it was a question. What's the return on all the equity? They said, well, wait a minute. I put down $25,000 and this is how much I get every month. Over a year. It was a great investment. No, 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 no. You're telling me what a cash on cash return is. I didn't ask for that. I asked, what is the equity that's grown since you bought the building 15, 20, 25, 30 years ago? What is that giving back to you? And they have no clue how to answer that. And this is a good example of what happens when you sell and you exchange that equity and what the equity can re-leverage to buy you. So let's talk about the calculations on how to figure out what a cash on equity return is and how to figure it out. I think this is you guys. Okay, this one you're going to get next. This is the best one in the world. This one's going to make you money. Number one, it's a very simple formula. How do you figure out what the rate of return is on the equity that's grown in all those years? How much am I getting this year? How hard is my building working? Is my building watching television, eating popcorn and drinking soda? Or is it out working, making me money? How much is the equity doing for me? And this is how you figure out. Number one, what is the gross income of the building every month for a year? Number two, what does the building cost me in terms of expenses? Now, let me ask you a question. Who pays for the gardener? Yeah, the landlord, right? I do. Who pays for the water? Who pays for the trash? Who pays for the property taxes? Who pays every time somebody has a problem that's got to be fixed? What happens when somebody moves out? Who has to clean it up and re-advertise it and do whatever I need to do? Or replace the carpet? It's all, I have to pay the CPA. I have to call an attorney to do an eviction if that's what it takes. And I have somebody who's not paying me. So my question is, what are my expenses every year? That's where number two goes. Number three, you want to find the net income. You subtract the expenses from the gross income that came in, and that tells you what your net income is after expenses. Number four is where you come in. Your job is to tell them how much equity is in the property based on the current value of the property. Not what it was worth 5 years ago, not what it's going to be worth 2 years from now, but what it is today if it were to close escrow today. And you can do that by how? Copying it out, figuring out what it would sell for today, but you also take whatever payoff there is of debt against the property, you subtract that from the current value, and what's left over is equity, right? So that's number four. Number five, very simple. You take number three, the net income, you divide it by 4, the net equity, and that tells you what your percentage of return is on this property. That tells you what the rate of return is on all the equity that's in the property, and the client can look at it and say, I'm happy or not happy. Now here, let me tell you a story. Well, before I tell you your story, I'm going to tell you something. Then I'm going to tell you a story. What do you think the average investor who's owned their property for more than 15 years is getting back on a return from their building based on all the equity that's sitting in it? How much? 10%? So they're making a 10% annualized return off the equity. Fair enough. Anybody else? Higher? Lower?
More.
17%. Lower? 3%?
Outside, but 15, 20.
15 to 20. Here's the answer. It's going to be a range. Everybody's going to be different. But the range is somewhere between 0.5% to 3.5%. And if you don't believe me, have your client do the math. I came up with this with a couple of CPAs and a commercial agent. It's very low. And they don't know that. They think they're getting a 20% return on their dollar. They're not. They are on the down payment they put in. Shouldn't the equity that's grown in the building for 15 or 20 or 25 years be bringing in income for them as well? Let me tell you something about income very quickly, or equity. Equity is nothing. It's paper. If it doesn't produce income, you can't spend anything. You can say I have a building with $300 million of equity, but if it doesn't produce you any income, or very, very low income, what are you going to spend it on? You have nothing to spend. It's paper. Equity has to do one of three things. Number one, produces rent. Number two, you can refinance it out and spend it, but you have to pay it back with interest. Or number three, you can sell the property, pay the taxes, and have the equity. But that's it. Those are the only three options that are out there. So the question is, how hard is the building working? And when you find out, it's, well, let me give you an example. I'll leave you, this is going to be my last story, maybe. I was speaking at a meeting in the San Fernando Valley. One of the agents said to me at this point in the seminar, or as we were speaking, she said, look, I want to tell you, right in front of everybody, just like this. She said, my mom is 85 years old. She has a building that I manage for her. I collect rent, I take care of everything. My mom, after I pay the expenses off, my mom is left with $5,000 a month income. So that's what she nets on the building every month. Now, there's no debt on the building, so I don't have to service any debt. So she has a fully paid property. My mom can't spend $5,000 a month. It's too much money for her. She doesn't do anything. Then she said this to me. Why should I sell the building? More income than I need? Fully paid for. Is that a good question?
Yeah.
It's an excellent question. Here's the answer. Answer will be left for the next time I come back. No. Here's the answer. She said the answer. No, I said to her, okay, well, I understand that. I'm not here to sell. My job is to do what? Bring value. Give people ideas. And that's your job too. You're not called to sell. You're called to meet people, find out what those needs are, and bring value to them. You're not supposed to sell. They don't like salespeople. They want people to help them make more money. That's what they're looking for. That make sense? Okay. So what happens is I said, fine. You may not want to sell the building, but wouldn't it be nice to know how hard the building is working for you? You know what she said? That is a good idea. I said, then just do this. She goes, okay. When the office meeting is over, my office is right around the back. You come see me at my desk. I said, okay, fine. When the office meeting was finished, and I finished talking to everybody, she just went like this. So I went to the back to her office, and I said, okay, what'd you come up with? And she says, this is everything I'm going to tell you now is what she said, not what I said. This is what she said. I just did the math. My mother is making barely 0.5% return. She goes, that's unacceptable to me. The way I see it, I can sell the building. I don't have to deal with management anymore. I can put the money in the bank, and if I get 1% on my money, 1%, I just doubled her income. I don't manage anymore. Or, she said, my mom's 85, so she's not going to live forever. I'm going to inherit this property. I can sell this building, and I can do a 1031 exchange and buy 3 properties with this and diversify it. And I'll be getting income, or she'll be getting income off of 3 buildings, not 1. And as the market appreciates, I'm going to appreciate with 3 buildings, not 1. There's my big question to you now. Did the light bulb just turn on in your head? Does this make sense?
Yes, yes.
This is not about selling. This is about education and going to investors and creating new relationships by you knowing already what's in it for them and what they want to hear about. It's just about that. That's all it is. Yes, sir.
But Phil, I speak to a lot of clients, and then their main emphasis is, why do I need to cash out? I'm making good money on a monthly basis. But after...
But did you do a cash on equity return?
No, I didn't do it your way.
I think you should do it that way. And then their disposition might change a little bit. Because they think they are making good money. It's just like that agent thought for her mother's building until she found out what it actually was in terms of a percentage of return.
But also, too, doesn't taxation come in? I mean, yeah, let's say you're making an extra $5,000, but then your depreciation is way down. Everything else, so your tax liability is increased. There's no leverage there. So
That's
that's what I'm starting to push.
And that's why the exchange is so good, because you can take that tax basis from the property you're selling, buy other property that can do better for you based on what you're looking for. And diversify, like remember, it could be diversifying they want to do. They don't want to put all their eggs in one basket. Let me tell you something. The average person you talk with, how long have they had their building?
When I was pitching for the property management, the average one was 5 to 7 years.
Okay. Have you looked at people who have had their properties at least 20 years?
No,
Let me tell you
I
something.
went beyond 7 years, and I was trying to work that before the 2006 market.
What was the average age of the person
The average age of the person,
that you talked to?
40s.
Okay, when you look at a property that's been held for 20 years or longer, guess what you're going to see?
60s.
People who are near or in retirement. And things change when you get close to retirement. What is it? What are the two most important things in retirement? Cash flow, security. They don't care about appreciation, and they don't care about depreciation. They care about that asset not going anywhere, safety, and that it what? Produces the income they need, so they don't have to depend on the government, and they can go live the life they want. Does that make sense?
Yes.
And talking with these people, but showing them what their rate of return is, with your name on it and whatnot, is a good way to begin a relationship to find out what's important to them and what they'd like to see in terms of a return. Because now if they're making 1% return, they may not be too happy. But if they're making a 5% return, they're happy, and you say, you know what, I don't know that I would sell the building. I think it's a good return. What have you just gained in front of a client? Credibility.
Yeah.
And maybe they have more than one building. The average investor has more than one building. Make sense?
Yeah. How do you see the market in the multi-unit sector? I mean,
Tight.
yeah, the commercial and things of that nature, but I'm just talking about multi-units, whether it be SFRs or 2 to 4 or 5 plus.
In demand, in demand, in demand. Especially 2 to 4, 5 and above. It's the #1 hottest property in the 1031 exchange. Everybody wants it. Why? Diversification. How about this? Potential. How about foreclosures? How about short sales? Where are these people going to go?
Rentals.
Guess what? People graduating from college now, they're not exactly finding the biggest jobs, the highest paying jobs. A lot of them are going to school for graduate degrees because they can't get a job. And a lot of them are going to just rent. And they say when they do graduate and they do get jobs, a lot of them are going to think twice about buying. Because they want all their toys. They want a Beamer. They want their iPad. They want everything. And something can't be there. So they would rather rent than buy. It's perfect for investors. Absolutely perfect. They're projecting rent to go through the roof over the next 10 years. There's parts of the country right now. I was just talking to my brother-in-law on the phone this last weekend. He's a real estate agent in the Annapolis, Maryland area, which is by Baltimore and Washington, D.C. They cannot find enough rentals for people to rent. Rents are going up. And that's what's happening here. They're projecting over the next 10 years to go up.
I started seeing from clients as well, the lenders are starting to come back into the game and to lend, and before where they were away from it, from multi-unit.
It's a good deal for the lenders. Those properties are going to increase in value, and the rents are going to increase. They're not going to go into foreclosure. Even through the last 4 or 5 years that we've been through this really ugly market, multiple units, very few of them went through problems. It was mainly single family and condo and commercial. But multiple unit residential remains strong and will continue to remain strong and get stronger. That's why those are the hottest properties in the world.
Awesome.
That's why if I was you, I'd be talking to those people to find out if they can do better and trying to get listings. Right now listings are the name of the game.
Now you've covered on an exchange. who do you recommend for us to take classes on? Just getting to know the numbers, the gross multiplier, you know, those kind of classes. Because I used to go, like Dwayne Gomer was out
Yes,
there, and he would
yes.
do a lot of those classes.
CCIM is very, very good. I would really consider joining CCIM. They will teach you everything you need to know. Like I have a flyer right here, but it's not really, how can I say this? This is not something to give out to your clients. This is something for you. Would you like to hand
Sure.
this out?
Anybody else? Because I mean, this is a lengthy, the CCIM is a lengthy process.
Yeah,
expensive
but it's
one.
worth it. But let me explain. That's the best one I think that's out there.
Got it.
Let me ask you a question. Has any of your clients ever approached you, any of you, and asked you this one question? If you find a good deal, would you call me?
Yeah.
Has anybody ever said that to you?
Yeah.
Maybe every day?
If I found it.
If you're out there prospecting, there's a lot of people that are going to talk to you about that. Here's the question. How do you know what a good deal is? Is it based on comps only? Not on rental property, it's not. Here's some of the items that are really valuable. Number one, what's the NOI, the net operating income on the property? You have to know what that is because the lender is going to do that for you to determine how much money they're going to lend you. Number two, what's the cap rates? And how do you figure out how do you understand what a cap rate is? This is nothing but a cheat sheet. You need a class to go through it to be able to really look at a property and understand. Because you won't be able to know what a good property is until you've learned how to analyze a property. You know what I'm saying? It isn't just comps. Number three, cash on cash return. That's what you measure when you want to buy a property, not the one you have. The one you have is a cash on equity return, that one, the purple one we just went over. Cash on cash is what you project when you want to buy something. Gross rent multipliers for multiple units. This is just the beginning of ways to understand how good a property is. You know, I actually have one more that I can give you if you'd like, a marketing piece. It's called Dear Homeowner. And again, you can get all this, just email me and I'll send it to you. But the Dear Homeowner goes, I'll read it really quick. This is for your farm, where you've done your selling to your single families and the people who own nothing but a home. They don't own a rental property. Those are good people to talk to. Why? Because you already have a relationship with them. They already see you. They already know your stuff. Or you've actually sold them properties. Let me just kind of go over this with you. It's very short. It's right to the point. It says, have you ever noticed, dear homeowner, have you ever noticed how property values seem to increase each decade? Is that true? Every 10 years, do property values go up? For the most part, they do. Are your current investment or your retirement nest egg producing for you the same kind of return, growth, tax advantages, and cash flow that investment property tends to yield? Let me ask you this question in another way. If you're in the stock market and the stock market crashes, which it just did a few years ago, what do you have left in your hand? Paper. But when the real estate market goes down in value, can you still collect rent?
Yep.
Absolutely. There's a big difference. So, can it produce for you the same as properties? The answer is no, it cannot. Next, is your financial security, isn't that what everybody's looking for?
Yeah.
Is it balanced with some investment in real estate, or can you be vulnerable or imbalanced in just mutual funds or the stock market? At the very least, do you have a segment of your investments in retirement in property other than your home? Perhaps it's time to consider becoming more diversified with a balanced and more secure investment portfolio. This next one is really the kicker, and I want you to hear this. It seems that those who have been financially successful have done it by owning some type of investment in real estate. Of all the people you know who have the most amount of money, how many of them own investment real estate?
All of them.
Isn't that the truth? Now, these are not people who own real estate outside of their home. let me just tell you, let me end with this. I've been in the business since 1982. I began with a company called Safeco Title Insurance. You remember, anybody go far enough back to remember that? Later on, they were bought by Chicago Title, blah, blah, blah. Anyway, here's the bottom line. In 1982, when I came into business, interest rates had just fallen to 18.5%. You think life's tough at 3.5? Try 18.5. Let me tell you, I have never, since my career in 1982, have seen prices and interest rates down together at the same time. This has not happened in my lifetime, at least not in my professional career. You know what that's called? That's called opportunity knocking on the door. And this will not last forever. This is the perfect time to go to your homeowners. Here's another thing that homeowners are doing right now, and I'm one of them. We have money in an IRA, but I don't trust the stock market. And when the stock market goes down, what do I lose? Everything. So I'm going to take my IRA, a part of it, and I'm going to do something called a self-directed IRA, where I hire a custodian, and guess what I get to do with that money? I get to buy rental property. And everything that the rental property generates goes right back into the IRA. Which means what happens to my retirement? But the value of the property is going to go up too, not just the income that brings to it. You think that's a good deal for me?
Yeah.
Here's the, folks, you've got to get out there and talk to these people. Have a seminar. If you want to have an investor seminar where you invite to your office just people who've owned property for 15 or 20 or 25 or 30 years longer, I'll come in and talk about the 1031 exchange and some of the things we just covered today. Not to sell them anything, but just to educate them. Because at the end of the day, you know what I say? Goodbye. I'm going to the USC game. See ya. You know, the bottom line is that I'm not here to talk anybody into anything. I'm here to give them ideas. You see what I'm saying? And I can tell you, when I'm talking to investors, I can look into their eyes and I can watch the wheels turn. Because those people buy real estate to make money, and I know that. And I'm giving them ideas on how to expand that so they can make more. And they're interested. And that means at the end of the day or the evening or whatever they say to you, so what's out there?
Oh, you're asking me?
Yeah, no. Yeah, as somebody who attended it, so what's out there?
Right.
What can I do? It just gives you opportunity. And that's all you want, is opportunity to get in front of these people. Get that farm package. Take this one I just gave you, send it to the people you've been working with in your farm that are just single family only. And let me tell you one last thing. When I first took out my wife, very first day, my wife and I have been married for 24 years now, all right? When I took her out I remember I took her to Glendale, took her to Long Beach, we went to Bobby McGee's for dinner, and then we went to the Queen Mary walked around. I did not, at the end of that day, ask her to marry me. Did not do that. Why? There's no relationship. We just had a date. So why do you expect people to do business with you by farming them one time? It ain't gonna happen. It takes time to build a
Relationship.
and that's what our business is completely predicated on. Us bringing value to people on a constant basis. And that's how people get successful in this business, and that's how people make money in this business. Does that make sense?
Yes.
Makes a lot of sense.
I hope this was of value to you. Thank you for
It
having
was.
me here today.
Thank you.
I really appreciate it. Anytime you have a question, don't hesitate to call me. I'm happy to answer all your 1031 exchange questions. Never a problem. Thank you.
Thank you.
Thank you.